Surgery Partners, ticker SGRY, Q2 2026. A mixed bag. Revenue beat consensus, but EPS missed.
Big time.
Yeah, net revenue came in at $848.9 million actual versus the $830.05 million estimate. But the bottom line, a GAAP net loss of negative 12 cents per share.
Right, which widely missed the expected positive 6-cent profit.
Exactly. Now, management reaffirmed full year 2026 guidance. So they're targeting $3.335 billion to $3.45 billion in revenue and at least $530 million in adjusted EBITDA. And yet, despite that bottom line miss, the stock actually popped.
Yeah, roughly 2.8% up to around 15.96 in early trading right after the report.
So today we are acting as your financial guides. We're going to unpack these Q2 earnings transcripts, the investor slides, and the sell-side analyst notes.
Because we really need to figure out why Wall Street is rewarding a company that is, on paper at least, bleeding cash.
Right. Our mission for this deep dive is to just cut through the noise. We're going to examine their segment performance, the severe margin compression they're facing, and this massive portfolio-shifting divestiture that completely rewrites their balance sheet.
It is a really fascinating divergence between the headline earnings and the underlying operational narrative here.
Oh, for sure.
Because usually, when a company widely misses the bottom line and dips into negative territory like that, retail investors panic.
They hit the sell button.
Exactly. But institutional investors, they're looking past that GAAP net loss. They are focusing heavily on the organic growth metrics for the existing facilities,
which are showing some serious muscle.
Right. They really are.
So let's get into those metrics, because that is where the story starts to twist, right? Their same facility revenues increased by a solid 5.0% year over year.
Which sounds great on the surface.
It does. But looking at the operations data, that 5% revenue increase was absolutely not driven by like a massive influx of new patients.
No, not at all.
Same facility cases. So the actual volume of surgeries performed only increased by 0.3%.
Yeah, volume is essentially flat.
Right. So the real engine here was a 4.8% increase in revenue per case.
And that looks like simple pricing power on the surface, but it's actually a structural shift in their business model.
How so?
Well, they aren't just raising the prices on their standard menu of procedures, they are changing the menu entirely.
Okay, that makes sense.
The sources highlight that management has been strategically shifting their case mix, toward higher acuity, more complex procedure.
Right, they're heavily targeting those musculoskeletal service lines. So think total joint replacements, knees, hips, that sort of thing.
Exactly.
I see they also mentioned expanding their surgical robotics footprint. They stated they have 73 surgical robots deployed across the platform now.
Yeah, which is a significant capital investment.
But how does adding a robot translate into a 4.8% bump in revenue per case?
It really comes down to billing codes and efficiency. When a surgeon uses a robotic assistant for, say, a complex joint replacement, the facility can often bill at a higher acuity code.
Because the procedure utilizes specialized capital equipment.
Right, and it usually yields far better clinical outcomes with faster recovery times. So the technology literally changes the billing tier.
Wow.
Yeah. So for the same hour of operating room time, Surgery Partners is generating significantly higher reimbursement rates from commercial payers than they would for, a simpler, lower acuity procedure.
I love that mechanism. Operationally, it's like a high-end steakhouse serving roughly the same number of customers as last year, right?
Yeah, good analogy.
But they're successfully convincing everyone to order the dry-aged ribeye instead of the basic sirloin.
Exactly. They are maximizing the revenue extracted from every single table.
Or in this case, every single operating room.
Right.
But I have to push back here, because if they have that kind of pricing power and they're beating the consensus revenue estimates, why did the net loss widen to $15 million?
Yeah.
And even more concerning, why did operating cash flow drop from $81.3 million a year ago down to just $59.3 million this quarter?
Well, it's the most vital question you can ask when looking at these earnings. The cash flow drop is stark.
It really is.
What you're seeing is the sheer weight of their capital structure dragging down those operational wins.
We're looking at severe margin compression across the board, aren't we?
Oh, absolutely. Even though revenue is up, adjusted EBITDA dropped to $125.2 million.
Which brought their EBITDA margins down to 14.7%.
Right. Compared to 15.6% a year ago, the profit is just being eaten alive by extraordinarily high interest expenses.
Tied to a very heavy debt load.
Exactly.
So let's translate that debt load for the listener. The slide deck says they are sitting at 4.4 times net debt to EBITDA.
which is high.
Very high. How much cash is that actually sucking out of the business on a quarterly basis?
Well, their interest expense for this single quarter was $69.8 million.
Wow, just for one quarter.
Right. If you annualize that, it's roughly $280 million flying out the door every year just to service the debt.
That's brutal.
And the mechanism hurting them here is floating rate debt. In a high interest rate environment, floating debt is incredibly punishing.
Because the cost of carrying that debt has surged over the last 2 years as the Federal Reserve raised rates.
Exactly. And when you combine that brutal interest burden with other operational headwinds they cited.
Like the planned reestablishment of incentive compensation for staff, right?
Yeah, and some newly introduced provider taxes. When you add all that up, the cash flow contraction of 27% year over year becomes very easy to understand.
Floating debt is essentially like having an adjustable rate mortgage that resets every time the Federal Reserve sneezes.
That's exactly what it is.
Even though Surgery Partners is bringing in more cash from these high-acuity robotic surgeries, their monthly debt mortgage payment basically keeps ballooning.
Right, it traps them on a treadmill.
They're running faster, performing more complex procedures just to pay the bank.
And management is acutely aware of this structural bottleneck. I mean, you can't out-earn a $70 million quarterly interest expense just by doing a few more knee replacements.
No, you need a structural fix.
Precisely.
Which perfectly explains why we're seeing this massive strategic pivot. If their debt service is eating all the profits, they need a massive lump sum of cash to break the cycle.
Right.
Is that why they are suddenly offloading their Idaho Falls assets? Because, I mean, this divestiture seems to be the absolute catalyst for the stock's post-earnings pop.
Oh, it is undeniably the catalyst. Surgery Partners is executing a highly transformative divestiture here.
Let's get into the details on that.
So they are selling their ownership interests in Mountain View Hospital and Idaho Falls Community Hospital.
So their existing partner, Intermountain Health.
Yes.
Yeah.
And the total consideration flowing to Surgery Partners is roughly $795 million.
Which values the combined facilities at about $1.115 billion.
Yeah.
So I was looking at the breakdown of Idaho Falls in the investor notes, and it generated $765 million in annualized revenue.
It's huge.
That is a massive chunk of top-line revenue to just walk away from. And it doesn't look like their typical short-stay surgery center.
No, not at all.
What exactly are they operating over there that makes it such a drag on their broader strategy?
Well, the facility profile is completely different from their core business. Idaho Falls is not a pure ambulatory surgery center or ASC.
Right.
It's essentially a full-blown acute care hospital. So it includes non-core traditional hospital services like obstetrics, neonatology, inpatient pediatrics.
I think I even saw a retail and compounding pharmacy in there.
Yes, exactly. And maintaining a 247 inpatient hospital infrastructure, it just requires massive overhead.
Because you have to staff overnight nurses, maintain emergency capacities, manage complex multi-day patient stays.
Right. It's incredibly capital intensive compared to an elective short-stay surgery center where, the doors literally close at 6 p.m.
And the payer mix for a traditional hospital must look vastly different too. I would imagine an emergency room or a maternity ward brings in a much higher percentage of government-funded health care.
That is the crucial mechanism behind this sale right there. Traditional hospital services inherently carry a higher Medicaid patient load.
And for anyone analyzing healthcare stocks, you have to remember that Medicaid notoriously reimburses at a fraction of commercial insurance rates.
Right. Sometimes it barely covers the actual cost of care.
Yep.
So by selling this Idaho Falls asset, Surgery Partners is cutting its total Medicaid payer mix by 50%.
Wow.
Let me emphasize that. A 50% reduction in their lowest paying demographic.
That brings their total annualized Medicaid exposure to under 2% of total revenue? Right.
Exactly. Under 2%.
That is a staggering shift. I mean, getting Medicaid exposure under 2% essentially insulates them from state-level Medicaid rate cuts.
Which management explicitly noted as a headwind dragging on their margins in the first half of the year.
Right. But let me challenge this strategy for a second.
Sure.
The ultimate aha moment here seems to be that in modern healthcare economics, owning a massive full-service community hospital is actually a financial liability.
Compared to owning a tiny, hyper-specialized outpatient clinic, yes.
Big scale used to mean big profits. Now it apparently just means big debt.
Pretty much.
But Idaho Falls distributed $54 million in cash to Surgery Partners in 2023. Are they giving up too much reliable cash flow just to get that lump sum?
Well, it requires looking at the multiple they achieved. Yes, they're giving up 54 million in annual cash distributions.
Right.
However, the chief financial officer pointed out that the 795 million gross consideration equates to roughly 17 times that average annual distribution.
Ah, I see.
Yeah. And in the current M&A environment, 17 times cash flow is a premium valuation, especially to offload an asset that required 19 million in heavy capital expenditures just last year, just to maintain that 247 infrastructure.
So they are securing a premium price to shed their most capital-intensive asset. And what exactly happens to that 795 million once the check clears? The sources mention reducing leverage by 0.3 turns.
Right.
Let's translate that for the listener. When management says reducing leverage by 0.3 turns, they basically mean lowering the ratio of their total debt compared to their earnings.
Right.
It is essentially taking off a fraction of a very heavy backpack so the business can walk faster and keep more of what it earns.
That's a great way to put it. The deleveraging is the entire point. They plan to use the vast majority of those proceeds to pay down the most expensive tranches of their floating debt.
Okay, but beyond just the balance sheet repair, look at what remains. Once this deal closes, over 95% of Surgery Partners' remaining business will be pure outpatient or short-stay surgical care.
Yeah, which creates a highly focused, high-margin, high-acuity surgical portfolio.
And institutional investors love pure-play ambulatory surgery centers right now.
They do, because they're predictable, they're efficient, and they align perfectly with commercial insurance payers.
Because the payers are desperately trying to push procedures out of expensive traditional hospital settings and into these cheaper specialized clinics.
Exactly.
Okay, so the strategy makes perfect sense mechanically. But as a retail investor, we need to evaluate what the rest of 2026 actually looks like.
Because the 795 million isn't in the bank yet.
Right. They have a massive transformative deal hanging in the balance and a lot of macro risks swirling around them.
Well, the timing is critical to their guidance. Management reaffirmed their full-year guidance of at least 530 million in adjusted EBITDA.
Right.
But it's crucial for investors to understand that this reaffirmed guidance entirely excludes the Idaho Falls transaction.
So they are modeling the rest of the year conservatively, as if the deal hasn't closed yet.
Yes. For the third quarter, they project revenue to represent 25 to 25.5% of their full-year target.
I noticed the slide deck had a really compelling pro forma breakdown.
Oh, yeah.
If you completely strip out Idaho Falls from the historical data and just look at the new Surgery Partners, the organic adjusted EBITDA growth for that core portfolio is projected at 5.3%.
Right.
Which is noticeably higher than the 4.2% organic growth reported for the consolidated company.
And that 5.3% pro forma growth metric is the exact data point that gave Wall Street the confidence to bid the stock up.
Because it proves mathematically that the core short-stay business is actually outperforming the broader portfolio.
Exactly. It validates management's thesis that the underlying surgery center business is highly profitable.
It's just that its true performance has been masked by the capital-intensive hospital operations dragging down the average.
Right.
But we can't ignore the execution risks. We need to detail the hurdles here, because getting a nearly billion-dollar healthcare transaction across the finish line is never simple.
No, it's not. The primary risk is regulatory.
Hmm.
The Idaho Falls deal requires physician member approvals and governing board sign-offs, but more importantly, it is subject to the Hart-Scott-Rodino antitrust waiting periods.
So for anyone unfamiliar with that process, Hart-Scott-Rodino is essentially a mandatory pause button pressed by the federal government.
That's exactly what it is.
Whenever a merger or acquisition hits a certain dollar threshold, the companies have to notify the Federal Trade Commission and the Department of Justice and then wait 30 days before closing the deal.
Right.
This basically gives the government time to investigate whether the sale will create a monopoly or reduce competition in that specific local market. So in this case, Idaho.
And in the current regulatory environment, the FTC has been heavily scrutinizing healthcare consolidation.
Oh, absolutely.
So if the government decides to issue what's called a second request for more information, that 30-day waiting period can stretch into several months of legal review.
Which would be bad.
Very bad. Any regulatory delay is highly punitive to Surgery Partners.
Because every single month the deal doesn't close, that floating debt continues to accrue high interest, bleeding their operating cash flow.
Exactly.
And the macro risks don't pause while they wait for the government ink to dry. They're still dealing with potential commercial rate pressures in their remaining markets.
Yeah, that's true.
I also noticed a potential yellow flag in the analyst reports regarding insider selling.
Oh,
The sources point out that executives made 0 open market stock purchases over the past 6 months, but they completed multiple stock sales.
okay, yeah.
Now, executives sell stock for many reasons, right? Buying a house, tax obligations,
Right.
but 0 purchases while the balance sheet is under this much stress is something retail investors usually flag.
It's definitely something to watch.
So as a retail investor looking at this, how heavily should you discount the stock for the risk of the Idaho deal stalling?
Yeah.
I mean, is the 5% pricing power from those surgical robots enough of a safety net if regulatory red tape delays the cash infusion?
It's a critical question of margin of safety, really. You have to discount the stock somewhat for deal completion risk.
Right.
Because if the deal stalls, that 4.4 times leverage ratio remains a significant albatross around their neck.
The debt doesn't just go away.
Exactly.
Yeah.
The 5% pricing power in the core business is incredibly strong, yes. But as the Q2 numbers plainly showed, it was not enough to prevent a $15 million GAAP net loss when weighed against nearly $70 million in quarterly interest expense.
Right.
So the entire bullish thesis for the stock right now relies on that balance sheet deleveraging.
Because if the deal gets blocked by regulators, the narrative immediately shifts back from portfolio optimization to margin compression and debt service panic.
Exactly.
And we saw that exact fear reflected in some of the sell-side actions post-earnings. Zacks Investment Research actually downgraded the stock from strong buy to hold right after the report. Yeah, their note cited exactly that the widening GAAP net loss and the 27% drop in operating cash flow elevating balance sheet concerns in this high interest rate environment.
Which just shows that not everyone on Wall Street is willing to just assume the Federal Trade Commission waves this deal through perfectly on time.
Exactly. It's a race against the clock.
Right.
The operational engine is firing on all cylinders. I mean, they recruited 330 new physicians year to date. They're driving musculoskeletal volume, and they're leveraging advanced robotics.
But the financial chassis holding that engine is rattling under the weight of the debt.
Right.
The $795 million Idaho Falls sale is the new chassis. They just need the government to let them install it.
So let's summarize the core thesis for you, the listener. Surgery Partners is in the middle of a major high-stakes transition.
They are.
They're utilizing incredibly strong pricing power and technological upgrades in their core surgical markets to basically buy time. They're keeping the top-line revenue healthy while they try to execute a massive divestiture.
Right. The goal is to fix a heavy balance sheet, escape the crushing weight of floating interest rates, and completely pivot away from low-margin Medicaid exposure.
It's a textbook portfolio optimization strategy, assuming they can actually execute it.
Exactly. They are prioritizing cash flow conversion and aggressive deleveraging over sheer revenue scale.
By stripping away the massive acute care hospital assets, they simplify the business down to its most profitable, capital-efficient denominator, the short-stay ambulatory surgery center.
Which is exactly what the market wants to see.
Right, which leaves us with a final forward-looking thought for you to ponder as you watch this ticker.
Okay.
If Surgery Partners successfully sheds these non-core hospital assets, drops its Medicaid exposure to near zero, and dramatically pays down that floating debt, do they suddenly become the ultimate, clean, pure-play target for a major healthcare buyout?
Oh, wow.
I mean, think about it. If you are a massive health system or a private equity firm flush with cash, this newly streamlined, highly profitable version of SGRY starts looking less like a distressed asset and much more like a very appetizing acquisition target.
It's a very logical endpoint to consider, honestly. The healthcare sector is seeing ongoing consolidation right now.
Yeah.
And a clean balance sheet combined with a scalable, robotics-driven core business makes for a highly attractive target. The next few months of regulatory review will be the ultimate deciding factor.
We will certainly be watching to see if that Hart-Scott-Rodino waiting period clears smoothly or if the government decides to tap the brakes. Thank you for joining us as we unpack the mechanisms behind this complex quarter. Be sure to follow the show for your daily earnings coverage, where we break down the numbers that actually matter.